Welcome to Market Brief After Hours. It has been a highly volatile day on Wall Street, with major indexes taking a serious hit as rising bond yields continue to rattle investors. We're also watching escalating geopolitical tensions and some massive swings in individual stocks. There is a lot to unpack. To get us started, what exactly triggered this aggressive sell-off today?
It really comes down to a battle of wills between the U.S. Treasury and the bond market. The Treasury Department tried to step in with an extraordinary debt buyback operation to calm things down, but the market essentially shrugged it off. Bond yields marched right back up, and that raised major concerns that higher borrowing costs are going to throw a serious wrench into this bull market. When borrowing costs rise, equities tend to suffer, and that's exactly what we saw play out.
Let's put some numbers to that pain. How did the major U.S. indexes close today?
It was a tough session across the board. The Dow Jones Industrial Average shed 704 points, which is a 1.32% drop, closing at 52,759. A massive 9% drop in Walmart shares really dragged the Dow down. Meanwhile, the S&P 500 lost 0.87% to close at 7,641, and the Nasdaq Composite dropped 1% to finish at 26,067.
You mentioned the Treasury's buyback program failing to subdue those yields. Can you walk us through what happened there? Because normally when the government steps in to buy back its own debt, yields are supposed to fall, right?
That's the theory. On Wednesday, the Treasury Department, led by Secretary Scott Bessent, announced it would at least double its repurchases of 10, 20, and 30-year debt starting September 9th. Yields did tumble initially after that announcement, but by Thursday, that entire relief rally completely unwound. The yield on the 10-year Treasury note climbed back up, ending the day more than 4 basis points higher at 4.702% and even touching 4.704% intraday. The 30-year Treasury bond yield added more than 5 basis points to settle at 5.248% after spiking to its highest level in nearly 20 years earlier in the week.
Why is the market resisting this intervention?
There are massive structural forces at play that are simply beyond the Treasury's control. For one, the U.S. national debt just pushed past the historic $40 trillion mark. On top of that, there's record corporate debt issuance tied to the artificial intelligence build-out. Investors are demanding a higher term premium, essentially more yield, to hold long-term government debt because of all this supply. Secretary Bessent did mention that the buyback could end up being larger than the announced $4 billion, but many market participants are skeptical. The general consensus is that a $4 billion Band-Aid isn't going to cure what ails a multi-trillion-dollar bond market.
And as if bond market anxiety wasn't enough, geopolitical tensions are adding fuel to the fire, specifically with oil prices. What's happening there?
Yes, oil prices jumped on Thursday after peace talks between the U.S. and Iran collapsed. President Donald Trump posted on Truth Social that the U.S. would initiate the most crushing economic operation ever taken against any country, calling it unprecedented economic warfare. Following up on that, Secretary Bessent confirmed that the U.S. is imposing the toughest sanctions in history against Iran, including a blockade to collapse the regime.
How did the energy markets react to those statements?
Naturally, prices spiked. Global benchmark Brent crude futures rose 2.4% to close at $93.78 per barrel, while West Texas Intermediate crude for October delivery rose nearly 3% to settle at $86.83 per barrel. Bessent did try to calm broader military fears by stating that this economic pressure actually means a return to large-scale combat operations is unlikely, but the oil market is clearly pricing in a tighter supply risk.
We have a lot more to cover, including a look at international markets, a massive rally in cryptocurrency, and today's wildest stock movers. But first, let's take a quick break. Stay with us. Welcome back to Market Brief After Hours. Let's shift our gaze across the Atlantic. Europe also seemed to be feeling the weight of these geopolitical tensions. How did those markets fare?
European stocks closed mostly lower on Thursday. Aside from the U.S.-Iran tensions and rising oil prices, investors were spooked by fresh data out of Germany showing that producer price inflation rose 3% year-on-year in July. That's the 4th straight month of growth and the fastest increase since April 2023, driven mostly by a 5.4% jump in intermediate goods. On a monthly basis, German producer prices rebounded by 1.1%.
That definitely puts pressure on central banks. What were the final index numbers for Europe?
The Pan-European Stoxx 600 edged down 0.12%.
Germany's DAX lost 0.42%, and France's CAC 40 fell 0.57%. Over in Switzerland, the SMI settled lower by 0.13%. We did see some minor green, though. The UK's FTSE 100 edged up a tiny 0.04%, and Italy's FTSE MIB went up 0.09%. We also saw some weak economic data from the Eurozone, where construction output fell 1.3% month-on-month in June. But on a positive note, the UK's manufacturing sector showed a significant improvement. Their manufacturing order book balance rose sharply to -25% in August from -45% in July, with export orders recovering to normal levels for the first time in over 4 years.
Now, while Europe struggled, Asian markets actually had a pretty strong showing. What drove the optimism over there?
Asia caught the tailwind of Wednesday's initial U.S. debt buyback announcement before the trade unwound in the West. In China, the Shanghai Composite rose 0.24% after the People's Bank of China kept its key lending rates unchanged for the 15th straight month, and Beijing eased some housing fund savings restrictions. We also saw Chinese imports of U.S. soybeans surged 164% year-on-year in July. Hong Kong's Hang Seng Index jumped 0.80%.
And what about Japan and South Korea? They seem to have an even bigger rally.
They did. Japan's Nikkei surged 1.36%, and the broader Topics Index ended up 1.18%, led by tech giants like Kyosha Holdings, which soared 6%, and SoftBank Group, which advanced 3.1%. But the real showstopper was in Seoul. South Korean stocks skyrocketed. Chipmaker SK Hynix announced a massive 40 trillion won, that's about $28.3 billion, share repurchase program. That sent SK Hynix shares up a staggering 12.7%, which pushed the Kospi index up 5.89% on the day. Samsung Electronics also soared 9.5% on speculation that they might announce a similar shareholder return policy soon.
That is an incredible move for a major index. What about Australia?
Australia's S&P ASX 200 edged up 0.33%, snapping a 6-session losing streak. This came after some unexpected labor data showed Australia's unemployment rate rose to 4.5% in July, with the economy losing over 15,000 jobs. While bad for the economy, investors interpreted this as a sign that the Reserve Bank of Australia might hold off on further interest rate hikes.
That classic bad news is good news market logic. Speaking of economic data, we got some fresh numbers out of the U.S. today as well. How is the domestic labor market holding up?
It looks remarkably stable. Weekly jobless claims dipped by 6,000 to a seasonally adjusted 206,000, which was better than the 210,000 economists had forecast. This keeps claims at the lower end of their annual range, indicating that while hiring might be soft, actual layoffs remain very low. The overall U.S. jobless rate is sitting at a historically low 4.1%. We also got a massive surprise from the Philadelphia Fed's Manufacturing Index, which jumped to 47.4 in August. That's its highest level since April 2021, driven by a surge in the Employment Index to 27.9.
Wow, so manufacturing in that region is absolutely booming. Now let's talk about the massive move in the crypto space. Bitcoin has been on an absolute tear over the last 48 hours. What is driving this run?
Bitcoin surged near 7% on Thursday to trade around $72,900, bringing its 2-day gain to an impressive 15%. Ether also jumped 10% to $2,300, and Solana rose 6% to $87. This rally was initially triggered by Wednesday's pullback in Treasury yields, which eased pressure on risk assets. That move was then amplified by a massive short squeeze, liquidating roughly $2.7 billion in short positions. But the fundamental driver here is a last-ditch push from the White House and crypto industry leaders to pass the Clarity Act. Investors are optimistic that this bill could finally end the crypto winter, even though negotiations are currently hung up over ethics provisions regarding whether public officials can profit from crypto.
Let's pivot to the currency and commodity markets. What did the technicals look like for Forex today?
The euro-dollar pair, USD, consolidated near its recent highs, closing up a fraction at 1.1678. The technical structure here looks very constructive. It's trading above all its key moving averages, with the 50-day simple moving average at 1.1472, the 100-day at 1.1571, and the 200-day at 1.1629. If it can hold above 1.1669, the bullish momentum remains intact. Meanwhile, the British pound also extended its gains against the dollar. GBP USD closed up 0.17% at 1.3629, maintaining its recovery structure since the July bottom. On the flip side, the US dollar rebounded sharply against the Japanese yen. USD JPY closed up 0.61% at 159.12, signaling a decisive rejection of lower prices and a potential base-building phase around the 157 to 158 area.
And how did precious metals perform amidst all this currency and bond market volatility?
Gold extended its recovery, closing up 0.13% at $4,528. It continues to trade well above its key moving averages, with the 50-day simple moving average at $4,164, the 100-day at $4,391, and the 200-day at $4,498. Silver had an even stronger session, surging 2.03% to close at $68.26. It's aggressively testing its 100-day moving average of $68.62, and a close above that could open the path toward the 200-day average near $71.14.
All right, before we wrap up, let's talk about some of the individual stock movers making headlines today. We saw some massive double-digit moves. Who were the biggest losers?
The biggest casualty of the day was Advance Auto Parts. They closed down more than 24% after reporting that second quarter comparable sales unexpectedly fell 0.5%, completely missing Wall Street's expectations of a 1.31% increase. Moderna was another major loser, dropping more than 23%, as it gave back some of its massive 177% surge from Wednesday. We also saw CrowdStrike drop more than 5%, following news that their chief technology officer, Ilya Zaitsev, is leaving to launch an AI-focused cybersecurity venture fund. And as we mentioned earlier, Walmart's 9% drop after missing comparable sales and earnings forecasts really hurt the broader market.
Some brutal drops there. Were there any bright spots in the equity market?
Absolutely. Nordson closed up 8% to lead the S&P 500 gainers after posting stronger than expected third-quarter sales of $817.7 million and raising its full-year adjusted earnings forecast. Deere & Company also had a great day, closing up more than 6%. They reported third-quarter net income of $1.38 billion, beating consensus estimates, and raised their full-year net income guidance.
It's clear that while macro pressures are weighing on the broader market, individual companies with strong earnings are still finding a way to shine. That is all for today's episode. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform.